Welcome, everyone, and thank you for joining us for today's webinar as we take a look at the latest MSCI South Africa Annual Green Property Index results. I am Anelisa Keke, sustainability professional, and your humble host for today's proceedings. We are joined this morning by Eileen Andrew, wave Eileen, who is the Vice President of Client Coverage at MSCI South Africa, as well as a panel of industry experts, including Georgina Smit. Wave Georgina, please. Thank you. The GBCSA's Executive Director and Head of Technical, Heidi Barnes, the Head of Sustainable Finance at Absa CIB, and Engelbert Binedell, the Chief Operating Officer for Growthpoint Properties. Welcome. Thank you very much for joining us today. So, Growthpoint Properties sponsors this index, investing in key research and hard data to drive the green building business case. As Growthpoint's representative is here today, I'd like to introduce Engelbert Binedell to formally open today's proceedings. More about Engelbert. With over 2 decades of experience in the property industry, Engelbert is a seasoned executive recognized for his strategic vision and leadership. His career began as a teacher, where he developed a deep passion for people and their personal growth. He later joined the risk department at Investec Private Bank. His interest in real estate led him to Investec Property Group. He gained his MBL and managed a diverse portfolio of assets, including those owned by Growthpoint, Netboard, and Investec. Following Growthpoint's buyout from Investec, he has held several key leadership positions within the company, including Head of Asset Management for Industrial. In his current role as Chief Operations Officer, he oversees the company's day-to-day operations, encompassing property management, leasing, information technology, legal, and training. Leading a team of over 400 professionals, Engelbert is dedicated to driving growth, innovation, and operational excellence within the property sector. Beyond his responsibilities at Growthpoint, he is a director of Growthpoint Management Services and serves on the board of the Green Building Council of South Africa, further contributing to sustainable and forward-looking practices within the industry. Engelbert, over to you.
Thank you very much, Anelisa, and it's a privilege to join you on the webinar today, so thank you very much for that. In our sponsorship of this index from Growthpoint perspective, you really need to go back to 2007 when the GBSA was established. I call it when the movement started, and it would be amiss of me not to give credit to the late Rudolf Pienaar, who was a colleague of mine at the time, who really took sustainable development and certifications to a new level. He was a bit of he steamrolled his way through the business, forcing us to adoption. But at the same time, it was also quite difficult for us because we lacked some credible South African data at the time, and we were highly reliant on the Green Building Council of Australia. And then in 2016, we decided to sponsor this MSCI SA Green Property Index. And the result is that we've now got independent and globally aligned data available to track performance of these properties. So we're proudly associated with both the GBCSA, MSCI in terms of this index, and we can see the benefits coming through in everything that we do at the moment, because the data is credible, it's reliable, and it builds a case for sustainable development certifications in the property industry. Thank you, Anelisa.
Excellent. Thank you very much, Engelbert. And thank you to Growthpoint for sponsoring this research, which really benefits the entire sector. So to our audience, let's do a little bit of housekeeping. I encourage you all to leave comments and ask questions in the chat option provided. I'll be happy to cover as many of these questions that come through as possible with our panel during the Q&A at the end of the webinar. So let's proceed and kick off with the MSCI presentation this morning, which will be presented by Eileen Andrew. Just as a quick introduction to Eileen, Eileen's role at the MSCI provides her with a unique perspective of real estate investment strategy and portfolio optimization. Now as Vice President at MSCI, Eileen has experience working with both South African and multinational real estate funds, gathered from her 16 years with the MSCI, previously the IPD, both in South Africa and London. She holds a degree in mathematics and human geography from Wits University. Eileen believes that the numbers tell the real story, and that makes for better investment decisions. Eileen, over to you.
Thanks very much, Anelisa. That is a mouthful. I am sharing my screen with you now. Okay. So thank you very much. And thank you to everybody who's joined us on this call. It's always a pleasure to release these results because it always is great to see actual evidence of what we do in our everyday lives and this whole idea around climate and climate risk. And I'm talking a long way about that and actually see that come through in numbers and to share those numbers with you. Thank you also to Engelbert and to Growthpoint for sponsoring this since 2016. We walked a long journey, and with Rudolph before that, he was very enthusiastic always about this, which was great in those early days. And thank you also to the GBCSA for the work that you do alongside us on this index. So while I'm saying thank you to everybody, I also want to thank the wider community of real estate owners that we get our data from. So you'll see the screen in front of you. These are the contributing funds or our clients, and we collect from them on a biannual basis their full financial data. So we collect income statements and we collect valuations and everything that goes into the valuation so that we can calculate the returns. And we do that on a consistent basis across every single one of our funds, which gives our benchmarks credibility when we're comparing different asset types, both in South Africa and globally as well. What we've started doing for the last few years, the last 3 years now, is collecting what we call green data at MSCI. Green data is typically electricity or water usage data. And actually in South Africa, we've been doing this for a lot longer than we've been doing it in other markets. Through Europe, we're a little bit leading the charge in that way. But we have got we get usage data, we get CO2, so carbon emissions data, certifications, and everything else that sort of pertains to the environmental or the greenness of a building, how a building gets used from an environmental perspective. And why we've started doing that is because we're starting to measure climate risk. So indulge me for a moment while I just talk about climate risk before we actually get into the index results. Climate risk is sort of what sits on top of the green index and why we measure the green index, and it's permeating into all different businesses within MSCI, but within investors' thought processes. So when investors are making their financial decisions around whether or not they're going to allocate capital into an asset class, whether that's through an equity, so buying Growthpoint on the stock exchange, or whether you actually are Growthpoint and you're buying the asset itself, we need to start thinking about how does climate risk impact the value of that investment. And we're starting to see this climb very much higher on the agenda. Every single year we see this get higher and higher in the way that investors are thinking about allocating capital. What are the risks associated with climate into the future that they need to be aware of? And we've seen banks thinking about it very, very highly. We're thinking asset owners thinking about it very highly. And so obviously MSCI, it's become a key focus for us in our business as well. How exactly we're doing that is in 3 different ways. So, and the way the world is thinking about this, where investors are thinking about this in 3 different ways. The first thing they're trying to do is measure what is the carbon footprint. So what is the actual carbon emission that comes out of an investment? We're talking about real estate, actual physical property today. So what is the carbon emission that comes out of the buildings themselves? That's starting on the right-hand side. Then we can look at what is the impact that that carbon has on the environment going forward. And we look at implied temperature rise to understand that. So how much will that carbon impact future temperatures, or the temperature that we might see global or climate change actually rise to? And then we look at risk, and risk, when we look at climate risk, we measure climate risk in 2 different ways. We think about physical risk and we think about transition risk. Physical risk is to do with the location of the building, and there's a number of different risk factors that we will take into consideration at MSCI, but we're not limited. I think we cover 11 at MSCI, but there's obviously many, many more risk factors that are actually out there. I think the most pertinent ones to South Africa that we've seen are fluvial flooding, general flooding, so actual river flooding, so fluvial flooding, pluvial flooding. I've got to think about these, implied or extreme temperature, and then extreme precipitation. And I think the extreme precipitation is one that we've seen or we've experienced in South Africa, again, with the recent flooding in the Eastern Cape. And then looking at transition risk effectively takes the amount of carbon and what it costs to decarbonize over future periods and looks at the present value. So all of these taking climate risk and bringing them into a financial way of thinking about this so that investors can think or understand the risk or quantify the risk in a way that then can be applied to the investment decision. Okay, so what we did, and MSCI in recent years has bought a what we call our climate lab, which effectively is a bunch of scientists that sits in Switzerland, and they're specialists in climate change and climate risk, and they're the guys that are actually building these future-looking climate models, because it is a key specialization, and it's, I've learned a huge amount sitting trying to them over the last few months. So what I asked them to do was run the South African real estate data set of about 400 billion rand through their climate risk models. And these were the results that they came back with. And I think it's very, very interesting. First of all, looking at the carbon footprint. So you can see the carbon footprint for our 400 billion. And we're collecting real emissions data from about 2/3 of that 400 billion rand. So this is not proxy data. Well, there is some proxy data in there, but there is a lot of real data from our actual clients as well. And you can see the carbon intensity sits at about 320 or 330. And because what we're starting to build here is a benchmark to say, this is what your average property in South Africa can emit. Obviously, we can start breaking this down and looking at this by region, looking at this by property type, and whatever other physical attribute we want to sort of segment the assets at. And that can start giving us guidance as to, just like we have guidance around vacancies and we have guidance around what returns are, or whatever other operating metric you want to think about, rental growth. Now we can start looking at climate factors as well and say, what is the average carbon intensity of a super regional shopping center or of an office that's located in KZN? Okay, so there's carbon footprinting. Then we looked at, in the middle here, we looked at physical and transition risk. And actually, surprisingly, when we ran this data through our physical risk model, you'll see that these numbers are really quite small. So, and when we started looking more and more at the physical risk modeling itself and looking at the assets which I know quite well, or some of the assets which I know quite well, I think many of our assets are quite resilient against physical risk. So we don't see a huge amount of physical risk coming through, but it's very important to understand which assets are exposed, because there are assets that are exposed to physical risk, even though the average show that these numbers are quite small. Then we've got transition risk, and here's really where we start to see an impairment on those values, because effectively how you would read this is 25% of the value of the assets by 2050 are at risk to climate because of the amount of carbon emissions that come out of those assets today. Okay. And so you can see how that number goes from 2.5% in 5 years' time all the way to 25% in 2050. And that's because of how we generate electricity primarily in South Africa. So that's got to do with transition risk. And then on the third slide, really, or the graph on the right-hand side, we're sitting at a 2.1% implied temperature rise. So in the perfect world, we want to sit at a 1.5 degree, and that's certainly the scenario that they ran this data on. And we're too high. So there's work to be done in South Africa, and there's definitely inherent climate risk in the South African market. Okay. I thought I'd just include this slide because I thought this was super interesting when I was working with the climate team, and they've got such great ways, and I'm a geographer by what I study. So this for me is super interesting. But you can see the two maps, and the maps in the 2050 time horizon. You can see how much darker blue areas there are, and that's because of increased heavy precipitation risk. And you can see particularly in the KZN area, look at the Eastern Cape area, even across the Gauteng area, there is higher and higher risk in this heavy precipitation as we go forward into time. So it becomes quite obvious, and a map is a great way of graphically showing that. Okay, so let's talk to the index results. One of the ways that we are trying to mitigate climate risk, or that an asset owner or an investor can mitigate climate risk, is by greening their building and then certifying it as green. And what I'm going to show you in this, or what's really come out in the data, is that the actual certification makes a difference. And we did it on a like-for-like basis. So we do it with offices and we'll do it with retail separately. Before I get into the South African results, let me show you what we've done in some of the other parts of the world. This is the Canadian Green Index, and here they have tracked certified Canadian properties, certified by BOMA or LEED, and then compared that to their all property index in terms of total return. So total return from their green index was 3.3% in 2024, and from the rest of the index was 2.7%. So the Canadian data showing a positive outcome, or a higher return for those certified assets. We run a similar index in France, and here the results are not as conclusive, where we're looking at green offices versus all offices. Their way of what they call green is both certified and labeled as green. So not necessarily only certified properties, but they also have a green tag on them for whatever other reason. But you can see sort of in the early years, green certified offices were producing higher results, but sort of from 2016 onwards, not so much the case. So one has to argue that perhaps having this label of green isn't sufficient, and what we need is the actual certification to come through. I'm just throwing that out there. I can't conclusively say that based on this French data. We haven't looked at it enough, but we certainly do see that coming through in the South African data. So let me talk to what we've done here and our index then. This is just the sample, so you can see how many assets we're sort of looking at. And we've moved from the early days in 2016, where only 20% of the offices, and here we're looking purely at prime and A grade office, 20% of those prime and A grade offices were green certified, and today 50% of them are. So we've seen a big movement here, and a huge amount of offices or properties starting to see certifications. They've picked up tremendously over the last few years, which is great for our data, because it means that we can draw deeper and deeper conclusions from this, because we can segment the data more and more. Retail, in the last 2 years, we've seen 9% of our sample being certified. So there is room for growth here, but I have no doubt that just like the offices grew tremendously over that 9-year period, we're going to see the same in retail. I'm not going to show you industrial results, because while there are certifications in the industrial, it's sort of dominated by one particular property owner, and so it's not really market representative. So we're going to stick to office and retail for the purposes of the index. Okay, so this is looking at total return across the time horizon. And what you can see throughout this time horizon is that the green bars, which is your certified offices, have had a better total return than the grey ones. Okay, if we go to sort of the annualized over the 9-year period, we've got a 6.7 versus 4.7% total return. Now, we know offices have not been in a great space in South Africa over the last 5 or 6 years. There's been a huge amount of excess supply, lots of different market forces, different ways that we interact with offices. So lots of reasons why offices have underperformed other sectors. But if you are still getting a 10.1% total return from your prime certified offices, that is an excellent return compared to that 8.9% of the non-certified offices. Okay, and in each year, even through the COVID years when things were going particularly poorly, we saw those certified offices have better returns. Here we're looking just at the capital growth portion of it. So how much has the value grown over the period of time? In 2024, the growth in the certified offices was 1.2% versus a 0.5% for the non-certified offices. And you can see there has been declining valuations in offices for a while now. But in each year, the decline in your certified offices has been less than the decline in your non-certified offices. And that really talks to a more resilient type of asset. So if you're thinking about your toolbox that you have to assist the asset and make it more resistant to market factors, green certification definitely comes through as one when we start thinking about this. The other thing that we started to look at was looking at the spread of assets. So often benchmark numbers are weighted averages, and then they might be skewed towards some of the larger assets. So we wanted to look at the spread of all the prime and certified officers. And what we're seeing is that 66% of your certified officers had a positive capital growth and only 33% had a negative capital growth. So you had a much higher chance, or 2/3 higher chance, for your property to have a positive capital growth if it was certified in last year than if it was not certified. The not certified was 51 to 47%, so very much half and half. Okay. Again, talking to the resilience of these assets. Digging under the hood a little bit on that capital growth, we look at cap rates on the left-hand side, and this is a conversation that we often have with valuers in the market. Your cap rates on the left-hand side showing that the prime offices do have lower cap rates, and that's just lower cap rates means that they generally have higher values, and you see the value per square meter on the right-hand side. I think the other thing that's really interesting in this slide is you'll see through 2020, 21 through to 2023, we have seen rising cap rates. Okay, the market's been under pressure, so we have seen cap rates softening over periods of time. And they've continued to soften for these non-certified officers from 2023 to 2024. However, cap rates for those certified officers, while they have softened through the periods, they've held steady. Okay, and so what we've seen is this red line, your gap, your difference between the certified cap rates and the non-certified cap rate is actually widened. It sat at about 20 basis points for a while, and now it's gone to 40 basis points. You can see in the early days, there was a very big difference in the cap rates, and that sort of closed, and now we're starting to see that gap widening again. Sorry, one other comment on this. What cap rates really are is an indicator of the inherent risk that sits within the income stream. Okay, how risky is that building? How likely is that building of losing its income stream? I mean, if you want to think about what is a cap rate in a sort of layman's terms, and what this is telling you is that your risk for your certified building is effectively lower than your non-certified building because you've de-risked it from climate risk. Okay, hope that makes sense. Here we're looking at income return. So let's look at the income side of things. We looked at the value side of things. Let's look at the income side of thing a little bit. And the relationship, income return is your relationship between the income generated and the value of the asset. So what does it cost you to actually get that income stream? And generally in the property market, we think of lower yield assets are your more prime assets, your nicer assets. And we saw that may have been the case in the early days. So 2016, we did see lower yields on your certified assets. And you can see a bit of a mixed bag through 2020, 21, 2023. And now we've seen actually in this last year on your certified assets, we've started to see yields move up, which means that the income has grown faster than the value. So even then the value on these green certified assets has grown more than the non-certified, the yield has moved up, which means the income has grown even faster. That's a great place to be in, and really does talk to the resilience of these assets in a market where it's tough. Okay, the opposite has happened on your certified buildings where we've seen yields come off because the value has grown slower. The value has grown slightly faster than the income has grown. Okay. Cost to income ratios sort of wrap up everything that has to do with the income, the vacancy, and what it costs you to run that property. And you can see cost to income ratio for a long time for your non-certified, for your certified buildings has been low, and very interestingly, in this year, it's dropped to 39%. The all property number, which is retail, offices, industrial, is at 42.8%. So the fact that these certified prime offices are below that at 39% is an amazing testament to what certification can do to a building itself. And you see that number for the non-certified rising up to 46%, which means that if you want to read it like this, for every 100 Rand that you're earning on that building, it costs you 46 Rand to run that building. If you're a non-certified, it costs you 39 Rand if you're a certified building. Getting a bit deeper into that income numbers, you're looking on the left-hand side at your net income per square meter. You can see here the green certified net income per square meter has continued to rise over the last 2 years, although there was this dip, which is explainable by market forces, same as the the non-certified, but it's held up a lot better, and it's actually increasing now as we're starting to see some sort of light at the end of the tunnel for offices. And I say that touching wood, but that's what we're hoping for. But we are seeing these green non-certified offices come off on that net income per square meter number. On the right-hand side, we're looking at vacancies picking up for your non-certified and continuing to drop on the certified properties, down to 11.1%. I just want to say the national average for vacancies in the work that we've just done very recently for SAPO is around 17%. So 11% compared to a national average of 17% is fantastic. A great position for any office to want to be in. The other thing we look at, like I said to you, is we're collecting the usage numbers and the CO2 emissions. So we have been doing this for a long time in South Africa, going back all the way to 2016. And when you initially look at these numbers, you think, well, actually, there's not a lot in it. There's not a huge difference between your green certified and your non-green certified in terms of having much lower usage. I want to just draw your attention, if I'm just going to flick back for one moment to this vacancy slide. It's called usage for a reason. When you have higher occupancy in the building is getting used more, and therefore what you see is higher usage of electricity and water. So there's, you can almost see the correlation between usage and vacancy. So while we want to have low vacancy, we have to understand that that comes with using our building. So we may actually end up seeing higher electricity and water numbers coming through in those buildings at the same time. What I also think, and this is something that's been a huge learning curve for me over this journey with the GBCSA, is that green building and green certification is not just about, and I'll leave Georgina to talk to this, but for me as a layperson in the green world, it's been a huge learning curve. Green building is not just about usage. It's much more than that. And your certification is much, much more than that. And I think we just need to keep bearing that in mind as we think about these numbers. Let me quickly touch on the retail before I close, and I think we're going to have a very interesting discussion. These are initial numbers, and what we would like to do over time as we see more certifications come through, and we will do it, is start breaking this down into, or segmenting into, more granular comparisons. So you're looking at super regionals versus super regionals, and smaller convenience retail versus convenience retail, and so on. Right now, we're taking a very broad brushstroke, and we're just looking at all retail. So certified retail giving us a return of 13.2%, and non-certified coming in at 11.8%, with higher capital growth on those certified numbers. Already showing us, pointing us in the direction that we saw the offices going in, even with those early days, with not that many certifications. We're still sitting on the right side of things. If we look at the income underpinning those numbers, net income growth on the green certified is better than the non-certified. There are lower vacancies, and your cost to income ratio is lower as well. So on all of them, the key operational metrics, green certified retail at this broad brushstroke level is better, or is giving us a better operational performance than those non-certified buildings. Okay. And Lisa, I'm not going to talk through the summary, but I will just say thank you, and I'm going to hand over back to you, and maybe we can get on with questions, and I'm very happy to maybe share slides if we need to, if there are any.
Excellent, Eileen, thank you so much for that presentation. I think it's great that you almost juxtapose the index results to climate resilience, as well as kind of comparable international trends. But without further ado, allow me to welcome our panelists. We will be having a 25-minute panel discussion followed by a 25-minute Q&A. So I do encourage everyone to please hang around. Panelists, please switch on your cameras. I've already introduced Eileen and Engelbert. I will now introduce Georgina Smit. She is the Executive Director, Head of Technical at the Green Building Council of South Africa. She oversees certification and research-related products that drive the property sector to design, build, and operate buildings in a more sustainable way. She manages the technical team at the GBCSA, who are responsible for independently certifying green and net zero buildings and identifying market leaders. Her daily responsibilities include driving market transformation through certification, which can verify tangible, quantifiable impacts, and providing customer-focused technical support to all stakeholders engaging with the GBCSA, both in the private sector and public sector. And of course, lastly, I'd like to introduce Heidi Barnes, the Head of Sustainable Finance for Absa CIB. Based in Johannesburg. She has over 10 years of banking experience. Within banking, her experience spans retail and investment banking, in-house consulting, and debt capital markets. Heidi developed and built the Absa Sustainable Finance capability within Absa and has developed client-focused sustainable finance solutions across the African continent. She holds a Bachelor of Engineering in Industrial Engineering from the University of Pretoria and an MPhil in Engineering for Sustainable Development from the University of Cambridge. So perhaps on a slightly more colloquial note, to everyone listening today, this is the Avengers of green buildings. So I do encourage you to ask any and all questions regarding green buildings in the Q&A function as well as in the chat. So let's get to it. Eileen, I want to start with you. Thank you very much, obviously, for presenting the index results to us. And one of my questions relates to the different asset classes included. We've seen retail, industrial, P grade and A grade offices. But do you anticipate similar results for secondary grade and C grade offices that have obtained Green Star certification? Or are those asset classes which are showing a slower recovery and reduction in vacancies than their P grade and A grade counterparts more likely to experience a quote unquote brown discount over time?
Yeah. So thanks, Anelisa. And yes, your latter comment, I think I would completely agree with that. I think we haven't seen many certifications in those types of offices particularly. I think because those offices and with the supply demand sort of dynamics in the market and the oversupply of those kinds of offices means that there isn't huge demand from the tenants and tenants willing to pay rentals, which sometimes plays through to the landlord's ability to spend capex on those buildings, which actually ends up leaving those buildings further behind. And that's where that brown discount comes in. So after 3, 4, 5, maybe 10 years of very little capex being spent on those buildings, it means that eventually there needs to be a brown discount, because to bring them into being certified or being up to the same sort of standard, it just becomes too costly, particularly in the current market.
Thanks for that insight, Eileen. And Georgina, I'd like to maybe just pivot to you. I mean, the results of the index show that green certified P grade and A grade offices, as well as retail and industrial assets, do perform better than their uncertified counterparts across several metrics. And ideally, that should provide a clear pathway to understanding the business case for commercial real estate assets being certified. But do you think that there should be a further differentiation drawn between entry-level green certifications and at higher performing assets on the certification scale? Or in your view, do these results provide an adequate proof of concept on the value of certifications irrespective of their level?
Thank you, Anelisa, and hi to everyone on the call. So, I mean, I think first off, the data that we've seen today does span, the wide or the range of certification options. So it's 4-star and 5-star and 6-star. And I think it, very clearly does demonstrate that there is value to choosing any scale of green over business as usual. So beyond that, more data would be great. We would love to have more data around, different levels of sustainability performance so that we can help and guide the market further. But I think, with data that always needs to be robust and it always needs to be fit for purpose. So if, to answer your question, it's around saying, well, why do we want this information? What's the purpose of this research? And, this touches on what Engelbert mentioned in the intro. It's to equip and empower decision makers with the numbers, the business case, the investment case for going green. Often when they're sitting on the fence, when they don't have an emotional or, like a value alignment with green. So we definitely would love to have data that, offers more of a differentiated view. because we obviously believe that we want to get as many buildings to 6-star as possible. But if I can use an example, if looking at our cost of green research and you're making a decision, are you going to go for a 4-star or a 6-star based on cost? Common sense will tell you that a 6-star building does cost more, and the data does demonstrate that. But it's not always the case, because once you've decided to go green, the specifics of your project could present opportunities or challenges, that are slightly different. So we definitely do value differentiated investment performance data, but I suspect that it won't be as clear or as uniform as the difference between certified and non-certified. And I think, from our perspective, and maybe from Captain Planet in the Avengers, we want to get everybody on the journey, right? So we want to try and influence this at scale, which means our challenge sometimes is to say, well, what is the minimum the market's going to do? And we need to make sure that at that minimum, there is still either the viable business case or we're seeing environmental impact. We need to be able to demonstrate a difference. And this data definitely does provide that evidence. We've got evidence that there's stronger returns, it mitigates risks, there's long-term value. And it really is about saying to decision makers, you now have the data to now turn what you think is either an idea or an intent into action. And we're hoping that that will be used in the right way. Thank you.
Thanks, Georgina. And maybe let me pivot to Heidi. From a sustainable finance perspective, what do you think of Georgina's view regarding the differentiation between levels of certification performance? In your view, do you feel that the financial sector should be applying the scale when structuring sustainable finance solutions, which, back to what Georgina said now, could potentially bolster the business case in order to influence the market accordingly?
Thanks, Anelisa. So I think first off, the part that I wanted to start off with is just the background. 10 years ago, the financial sector didn't really look at if the building had a green building certification or not. So the fact that the financial sector has walked the journey and has come alongside kind of property developers, I think that is a first step, which I think is really great. And I think in the first instance, the first step is to say what's in and what's out. So not differentiating, just saying, what do we classify as green and what don't we classify as green, and using certification in the built environment to use that differentiation as one mechanism and one tool that can be used. And I think that that's a good starting point. I think that now, that the market is evolving, I think it's been this case now for 5 years. It's an interesting point in time to reflect and to see how the market evolves. And I think in that space, there might be room for having that scale of green to say, the incentive is higher or lower based on the type of initiative you've done. I think what becomes interesting, and that's something to keep in mind, is that ultimately that can also then become a moral conversation, because maybe something that has both, if it's affordable housing or student housing and it's green, maybe that is seen by one person as more sustainable versus, a 6-star building. And that kind of creates really interesting moral debates around what do we put value on and where do our values lie, and how do we express that with the incentives that we provide. And I think there is scope and room for that to evolve in the market. And I think different banks might already assess it that way. But I think that, the first part is that I think it's great that the financial industry is moving towards it. And maybe the next part is kind of, if there's a very close correlation between a green building certification and a reduction in risk, can that actually change the way we look at regulatory capital, which then has an impact on interest rates more substantially? That would be, we're not there yet, but those would be like the steps we could work towards.
Yeah, thank you for that, Heidi. And I think you're quite right. But it almost then prompts another question, which I'll pose to you, Engelbert, in terms of the levels of certification, but also understanding the results of the index in the context of climate adaptation, which Eileen has spoken on in terms of the MSCI's products, of course. There are various types of physical climate risk that are emerging, which do put properties at risk. For example, the compounding effects of heat stress risk. But Engelbert, have you observed any changes in the insurance coverage or insurance pricing for assets located in areas that are vulnerable to extreme weather events and or chronic weather changes such as prolonged droughts, or is it still too soon?
Anelisa, yes, thank you very much. And maybe at the outset, Eileen, I thought that presentation really hit home. And when you pondered on, physical risk and transition risk, it really hit home in terms of the broader property industry and from a reporting point of view. But from a physical risk perspective, we have seen an increase in insurance premiums, and we are having to deal with that. That obviously increases our operating costs. But I think more importantly, physical risk and climate change is informing our decision making as to where we want to invest, and in particular where we want to disinvest from. And it's not just KZN in the Eastern Cape. I think the last couple of months we've seen the Western Cape also battered by winds and rains and the like. And often we have insurance premiums. So, we try and self-fund excess ups to a point in time, but we are definitely having to fork out a bit more money in terms of insurance cover. But I think very importantly is it informs where we want to be and in what areas specifically want to be and where it's a no-go for us.
Thanks for that, Engelbert. And I think that approach is probably where, as a sector, we need to end up, where this information actually informs investment decision-making and is not used as a quote-unquote add-on after the decision's been made, the asset's been acquired, and then you realize, oh, whoops, we have massive climate exposure here. But Georgina, let's maybe talk about the funds that do take that approach. The MSCI research, doesn't necessarily the index itself, rather, doesn't have metrics that are explicitly related to climate resilience, perhaps more to transition risk than to physical risks. By the way, physical risks, for the purposes of the audience, we're talking about extreme weather events like thunderstorms, flooding, etc. And we're also talking about more chronic weather changes such as droughts and long-term changes in climatic patterns. Sorry, I've got to educate my people before we proceed. But Georgina, following, Eileen's presentation and Engelbert's response, what role do Green Star certifications play in helping companies measure the robustness of asset-level climate resilience interventions? Because in my mind, the certification piece shouldn't live outside of or separate to that broader discussion about climate resilience.
No, thanks, Anelisa. So from a Green Star perspective, and in terms of all of our ratings, they definitely provide, we would argue, an excellent way to demonstrate how a building has considered climate resilience. I think there's, but it's worth understanding that maybe the tools as they currently sit haven't been explicit. They were kind of developed in about 2009, and so the language is not necessarily aligned with current climate resilience mitigation and adaptation terminology and jargon, but actually all of the data points to understand how is a building thinking about future risk. They exist within the Green Star rating system, particularly within the new build framework when you're busy with the new construction or a major refurb. So, it's safe to say from a climate mitigation perspective, all green building rating tools will look at resource efficiency and optimization. So, that's a function of looking at your passive design features, how you're decreasing your HVAC load, how you're thinking about alternative water supply. So that's, very core and central to a green building rating. But in terms of broader elements, and that's more around adaptation, where you're thinking about stormwater management, you're thinking about the biodiversity that you have on site and how that acts as an ecosystem service. When you're thinking about how have you designed your facade to make sure that you're not having uncomfortable temperatures inside for the building users, as temperature and future temperature increases arise. Those considerations are all there. They do need to be drawn out, which is why in our update of Green Star, which at the moment is limited to new buildings, but will now follow on through to all of our existing buildings, to interiors, to precincts ratings, resilience has now actually been brought out as its own category. And that, you know, there are various initiatives that will then tie in energy, in water, in stormwater management. But the ask for a project team, and this will be, you know, this is now embedded within the Green Star framework going forward, is to say, have you considered, are you incorporating, whether it's the design process or for existing buildings within the operational process, future climate modeling for the location that your building is located within, and how is this being communicated with the relevant stakeholders? You know, have you identified the risks that are going to threaten the short and long-term value and performance of this building? And what we've done is we've taken a lot of our local data, you know, in terms of climate change modeling for South Africa, and we've put that into like a really helpful guide for projects to look at localized, tailored data to consider things, you know, around heat stress, precipitation stress, things like natural disasters and other operational risks. So there's actually a plan, and ideally, you know, the building needs to respond to it. But yes, in short, if you know where to look, Green Star in effect has got a shopping list of data points that can demonstrate to a stakeholder where mitigation design features or operational features have been implemented to deal with climate resilience.
Thanks, Georgina. Great answer. And I think it, in my mind, also, you mentioned value and performance, the impact on asset value and performance. And Eileen, I'd like to just get your view on this, because allegedly, certain people in the market have been saying that it is almost impossible to calculate any sort of green premium, quote unquote, associated with green rated buildings. But in light of the positive impact on property values and operational metrics demonstrated through the index results, how would you respond to that assertion?
I mean, fundamentally, that is what we've done, is we've looked at our methodology, which is consistent globally, and we've said, can we see a difference when we segment by this very fixed criteria? And we can, it's quite clear that you're getting a lower cap rate and a higher value, and in effect, that higher return. So, and maybe that premium, you know, if you look at your net income number that drops through, and, you know, operational metrics like a cost to income ratio, which is your almost key ratio, as in what does it cost you to run an asset? How much are you getting an income from that asset? So while you might not, and I think sometimes in the world, we think about rent per square meter. So I can charge 100 Rand versus 102 Rand, and that's where the premium is seen. But the premium is so much better than that, or bigger than that, and it drops through that cost to income ratio, and effectively through the value as well, and the data, you know, effectively tells us that.
Great. And I appreciate you adding that point in at the beginning, that, you know, using a global methodology, because, you know, the skeptics might always say, yes, but you've sort of cherry picked some of the results to tell the story that you wanted to tell. But, you know, as is the case with so many other asset classes, Engelbert, you know, we see that the P grade and A grade market is quite competitive, especially when it comes to filling vacancies and growing rentals. Have you seen instances where Green Star certifications have proven useful in attracting blue chip office tenants in competitive nodes, even if at this stage it's not necessarily directly translating into higher rentals?
Yes, thank you, Anelisa. I think it's fair to say that the office sector has been challenging for the last 5 to 7 years, and I think the oversupply in the market didn't help anybody really. And just to dumb it down, for lack of a better word, I mean, clients have a huge choice of office space that's available, and where you're typically renting a C grade office space, you now have the ability to go and rent an A grade or a P grade office at a fractionally higher expense. But what we have found is any corporate or any listed entity, anybody that has an ESG strategy that's in place, are picking certified properties because they are also on a journey. And I think that is the space that we're going to be finding, some huge growth in, and it's going to be an exciting space going forward. I think everybody's onboarding, sustainability, their own carbon footprint, in terms of the ESG strategy and the likes. And I think that's where we will see quite a big divergence in rentals and rental growth. Right now, we're not seeing that growth, but it's a structural issue. It's got nothing to do with the certification of the property.
Thanks for that perspective, Engelbert. And guys, I think in the interest of time, I want to wrap up the panel discussion and then get to the Q&A. I see that we've already got some great questions coming through. But before we get to Q&A, Heidi, I'd like to close off with you. It is said by various sources, 80% of the buildings that will exist in 2050 have already been built. And in your view, from a sustainable finance perspective, does that 80% of building stock, quote unquote, in the South African context, present a risk in terms of the ability of those assets to adapt? Or does it present an opportunity to the sector and its financiers to gradually get those kinds of assets on track towards transitioning as we gradually move towards a lower carbon economy?
Thanks, Anelisa. I think so. From my perspective, is something that, I've had lots of chats internally about around that, from a sustainability perspective, we should be looking at a life cycle cost from a carbon perspective, from a water perspective, from a materials perspective of a specific building, not necessarily only at the in-use portion. Because if we look at it from a life cycle perspective, we look at the big picture. So I think that incorporating the existing building stock into our discussion is absolutely critical. And I think that, there are some certification tools such as the IC Edge, which I think is a relatively, if you have an existing building and you're just trying to get all your practices right and get the building up to scratch, it's a relatively quote unquote simple tool to get people on the journey. So I think that, I do think that in all things sustainability, you both have the risk and the opportunity. I think that with what Engelbert was saying around, there's places that they're not investing anymore, that's a big risk to the market because those can become stranded assets over time. And that can have lots of repercussions on social dimensions and social fiber that we exist under, et cetera, et cetera. We need to kind of take that all into account. But I also think that there is an upside in that, just because a building's existing and it doesn't have a certification yet, or it's operating in a way that isn't optimally efficient, doesn't mean it can't change. It doesn't mean that one can't take initiatives to implement them to increase resilience and make it stronger. And I think so from our perspective, we also want to see buildings that are not certified, that are kind of the older stock, but that are being taken on that journey for increased resilience. So I think both matters. It's not just about building new, wonderful, shiny 6-star buildings. We want to see those too, but it's also taking that old stock on the journey and kind of creating resilience from that perspective.
100%. And I think that's where everyone in the market, yes, it's important to obviously understand the impact on new developments, but existing buildings certainly can't be left behind for the reasons I think we've properly discussed in this panel discussion. Guys, let's move to Q&A. So the first question is from Natasha O'Reilly. Hi, Natasha. Eileen, I'm going to kick this one to you. How would the MSCI deal with the different green certifications, e.g. Edge versus Green Star, which have different focus areas?
So we've kind of answered that. Georgina gave us a really nice answer earlier. It's almost blended, so we don't discern between whether it's Edge or EBP or Green Star rated, whatever. 6 and 4. It's all of that stuff together. Okay. Can I just add something? Sorry, I want to, across everything that we've talked about, if I go back to our experience in 2016 when we were collecting data on green, and if I go back to sort of the early 2000s, I'm giving away my age, and we were collecting financial data and just pure operating metrics, we had a list of data points that we wanted as long as my arm. And now that stuff it's so automated, we can pull financial data completely seamlessly from the owners because systems have become such that it's not even a question anymore. And now we look at the environmental data, we've come up with a list of as long as our arm, from electricity usage down to biodiversity and how much diesel and how much this and how much the next thing. And I think sometimes I sit in front of owners with this list and they look at me like, this is an insane amount of questions you're asking. How can we possibly do this? But I think in 10 years' time, when we're sitting here, that stuff will become, we'll be able to pull that data, because systems and the way that buildings are managed and the way that data is so integrated into the building, we won't be having a discussion around should we be looking only at this or only at this. We'll be able to disseminate all those different things, but it's a journey that we're on. And eventually we'll be able to pinpoint each of the different parts and relate them back to climate risk. So I think my point is we're taking our first step still on this measuring climate risk journey.
Great, great. And Georgina, next question is from Alistair. He's asking, do you feel that all of the criteria in the GBCSA, I assume the tools, are fully up to date? Has tech advanced enough to require any kind of overhaul to what criteria would be needed to be met to say something is quote unquote green?
Thanks, Alistair. Great question. So yes, we do believe that the criteria are up to date in terms of new build, because we've just embarked on a massive update. So it's taken us about 3 years and it's been quite the process. Drop me your email and I can have some coffee with you and take you through all the updates. But they are really amazing in terms of looking at all of the global sustainability mega trends and understanding, how's that localized for our context. And a lot of those updates will now roll out to the other life cycles in which Green Star operates within, so within, EBP. And we are also in the process of sending out a request for proposal to update our benchmarking on energy and water across a whole bunch of typologies. So we've got a very good solid foundation that has stood the test of time over the last 15 years, and we've refined the tools as we've gone along. But there are some kind of framework updates happening currently to address, kind of alignment with global standards.
Okay, great. Georgina, Alistair is from Property Flash, so you're going to have to brush up on that media training before you have the discussion with them. But yes, please do reach out to any of our panelists if you'd like a bit more information. Thanks for that, Alistair. Now, Eileen, I've got a question for you. This is from Ilsa from Old Mutual Alternative Investments. She says, thanks for the interesting presentation. Is there any intention to analyze any of this type of data for the housing asset class, i.e. for property developments which are EDGE certified versus non-certified? Oh, Georgina, I saw your finger go up. How about Eileen, you answer first, and then Georgina, you can jump in.
Okay. So the short answer is yes, we are looking at it and we have looked at it. So we have overlaid our sample with what is certified in the residential market. We cover about 35,000 units in South Africa. We estimate that there's about 80,000 units in the market. So we're just sort of under half. A lot of that has to do with institutionalization of the residential market. We only cover institutionally valued or owned assets and externally valued. The residential market is very much still owned by developers, and then it's not necessarily institutional money. But as we see institutional money, and it's interesting that this comes from Old Mutual, but as we see more of that capital flow into those sort of investments, we will be able to track this. So absolutely, it's something we're thinking about and monitoring all the time.
Excellent.
I think just to add, we've tried in the last 4 years to really expand the data set, and every year I do give all of the typologies to Eileen, and we're hoping industrial is going to come on board next. But yes, also we definitely are tracking the resi, and I mean the IFC have done not the same study, but they have done more global studies to look at either the cost of greening in other emerging markets and the investment case, and it's not as detailed in terms of local data, but there is, I would say, global precedent that correlates and echoes the same story we've heard today.
Okay, great. Guys, in the audience, please keep the Q&A hot. Here we go. Question from Idumeleng. Hi, Idumeleng. With EPCs becoming mandatory from the 7th of December 2025, do you anticipate EPCs being incorporated into the index? Eileen, I'm kicking this to you, alongside green star ratings going forward. And if so, how might that influence future reported returns or yield spreads?
So it's very difficult for me to say how it might influence future returns and yield spreads. I can't really make a prediction on that, but will we incorporate them? Yes. On that arm's length of data or questions that we're asking the market, one of them is whether or not the property has got an EPC rating and what that rating is. What I can say is, and we haven't got great data on that. I'll be honest with you, it's not something that we've gotten a lot back from our general data contributors. So I think we need to do, as an industry, we need to do more work in being able to have this data readily available and sometimes aligned with financial data, because so I'm going to just, in the market, we code, every single asset has got a unique code. When we talk often, that unique code at the property fund isn't that unique. There'll be more of one of them. And so now, this is definitely getting into the detail, but my point is that we need to align ourselves better at how we hold data, and I think that's the journey we're on. What I will say in terms of EPCs, we have done work in the Netherlands where EPCs are mandatory and every single property has a rating. There we have found that properties with the lowest rating, and I think it's a 6 and a 7, are actually unsellable. So we track transactions in the market as well, and your rating is one of the first things that your buyer will look at. And if you're on the lowest rating, you can almost not sell that asset. So we talked about uninsurable assets, but unsellable assets is, I think, something we need to think about as well, especially in a market where we are looking at unloading some of the assets that we don't necessarily want on the balance sheet.
Yeah. And you know, I think we spoke about kind of residential, and one of the questions that was sent through beforehand from Sean from Zutari, he asked, do residential buyers really care about sustainable design when purchasing a home in a complex or estate? Engelbert, will you do me the honors?
Thanks, Anelisa. I don't think that's an honor because we don't really develop any residential, and certainly not our area of expertise. You know, I think one of the main sponsors of the convention and a big supporter of GBCSA is Baldwin. I think they've certainly gone to the market, and you know they're on this journey. You know, it'd be interesting to get their views on it. But I think when you're looking at residential estates, you know, where the housing crisis is, and you know, developments in that space, I don't think you know, just build and get it over and done with. But once again, I think when you look at your peers and some of your colleagues, I think people are making decisions around, you know, that residential property, you know, in terms of water backup and solar and the likes. And you know, I think there is a bit of a premium when it comes to, you know, that type of housing. But I'm not an expert in that field. I know what I would do, but I'm probably not a proxy for everybody.
No, duly noted. And maybe this is a question now for you, Georgina. This is from Joan. In the early days, there was a lot of talk of how many years it will take to recoup the costs, the break even of growing green. Is there new data that speaks to this? And what sort of cost premium are developers paying upfront to build green versus non-green?
Oh, my favorite question. The one that if I got money every time somebody asked me, I would be a rich gal. So yes, we have done a lot of research around the cost of green, and it was actually, you know, through the cost of green that we then moved on to you know, partnering with MSCI to then look at the operational cost. So the GBCSA, I think it was in 2014. Forgive me if the date's incorrect, but in order to answer that question for our members, partnered with the University of Pretoria and ASAQS, who are the Quantity Surveyor Association for South Africa. And we actually took local primary data from offices that were being built in South Africa. So the data was fed through from the QS to understand what that cost premium is. And that green cost premium so this is only on CapEx, it doesn't include any operational, which is also part of your question, but it looks at the fees to the GBCSA, it looks at the fees for your green building consultant, and then it also looked at any CapEx associated with achieving your desired sustainability performance against a baseline. So for example, putting in water harvesting tanks. And we've been able to demonstrate over the 8 or 9 years that the study has run, and based on data from actual projects in South Africa, that the cost premium associated with going green has definitely declined over the years. And with the latest results, the average was sitting at around 3%, but you could also build a building, 4-star Green Star new build office, at less than 0.5% in terms of your CapEx premium. So just to give you, an idea around that range. And so that information has been very helpful to stakeholders, when they're trying to understand, well, what kind of percentage should they be including. So at those, we haven't actually done a study where we've done, the payback on that, either 0.5% or to 3%. But, it's not insurmountable. So I can't imagine that it would be years and years in terms of payback. Happy to, and that study is publicly available, and happy to share it online with all the delegates once we're done.
Okay, excellent. Thank you very much, Georgina, and thanks for your question, Joan. We've got a question from Graham. Hi, Graham. And I'm going to kick it to Engelbert. Has the impact of renewable energy installations been ring-fenced as an influencing factor on green premium, property value, operating returns, capital value, etc., either on-site, e.g. rooftop solar, or off-site, e.g. wheeled energy? Property owners often track CapEx, OpEx, and ROI data, as opposed to other green building improvements, which are often integrated with total property budgets, so potentially simpler to calculate. Engelbert, do you want to give it a shot?
Yeah, Anelisa, I think it's a great question. When load shedding started way back when, I think everybody was slow to onboard, and I think, I'm talking Growthpoint, I think 2 years ago we doubled in 1 year what we had done in 10 years prior to that, and we continue to roll out solar. But we've also found, just installing solar, you can't install it and then walk away from it. So it's become quite scientific. You need to manage that. It's become an asset class, in my opinion, all by itself. And it is generating, proper income. And when you're valuing properties, you certainly are valuing that particular asset. But it has implied that property owners need to, have a different skill set almost to manage this particular asset, because even in Growthpoint's particular case, the amount of solar that we've installed, equate to some of our biggest real estate assets. So managing that fleet is incredibly important, but there's real value in it because you've pegged your capital cost at a point in time and you're not subject to fluctuation. But I think solar is part of an energy mix that every property owner should have. We've signed an energy mix within Etana, with some hydro and some wind, and that will supplement our solar. But even after doing all of that, I think we get to 32% of our total energy consumption. But to me, it's a massive opportunities for real estate companies. I think structurally an office building, rooftops aren't that big. They weren't built necessarily the right way. We've run out of space over there. Retail, there's still some opportunities, and industrial. And I think once we could put back into the grid, we could probably double what we've got at the moment. So I hope that answers Graham's question.
Okay, great. Thanks, Engelbert. I'm going to give the next question to Eileen. This is from Songo. She's asking, does the MSCI index consider other incentives like carbon credits and tax rebates?
No, We don't. We don't. We might find some of that come through in the operating metrics of the buildings themselves. So, you know, you might see that if that gets allocated to a building, if the carbon credit gets allocated to a building or the tax credit is to the building. To Engelbert's point a moment ago, with when we look at the solar, we can see the benefit of solar come through the income statement. And so anything on the income statement we'll end up picking up, but we don't otherwise specifically put that into the analysis.
All right, thanks, Eileen. Guys, keep the chat going. We've got about 5 minutes left, and then I'm going to go to closing statements. One of the questions that was sent through beforehand, and I'm going to pitch it to Georgina and Heidi. Can green certifications be seen as greenwashing to attract environmentally conscious investors, or is it actually making a real difference to the environment and overall energy and material consumption? So, Georgina, I'd like you to talk about whether or not it is actually making a real difference to the environment. And Heidi, I'd appreciate your view in terms of whether green certifications are seen as greenwashing through the context of the sustainable finance world, where the rules around limited assurance and verification are usually quite stringent. Georgina, then Heidi.
Great, thank you, Anelisa. So yes, definitely in terms of certifications, they definitely should be making a difference, because the criteria that we set are, you know, quantifiable metrics. You need to demonstrate they're significant. You know, it's not that we don't use woolly terms like energy efficient lighting. You know, there's an actual metric. You have to demonstrate that with calculations, with drawings. So I would say yes, they definitely are making a difference. Are we penetrating enough of the market to make a difference at scale? No. You know, so we obviously want to grow that green building movement from where we are with a lot of the REITs and a lot of the big funds, and, you know, to those kind of C-grade buildings. We definitely want to enable and allow every building to start a sustainability journey. I think where the risk of greenwashing comes in is where stakeholders in the market don't understand the difference between a rating that gives you a modeled result that you're meant to use when a building is being built during the construction phase. You've got a blank canvas, you're sitting with your design team, versus when you have a certification, when the building is an existing building and it's in use. And, you know, you can have a 6-star design building and it's got all the bells and whistles, but if it is badly managed, it will not deliver on its sustainability promise. So I think we need to, as a market, get to a point where we understand that impact for existing buildings is measured by in-use ratings. So an example of that would be the Green Star Existing Building Performance Rating, EBP, where you're looking at actual performance data. You know, and even some of the comments about older buildings, there are some older buildings that are actually far better designed than modern buildings, and they might likely outperform some of their modern, you know, counterparts, because that's measuring the actual carbon that is going out into the environment and the water that is being used, and is taking tests on the air quality, you know, and is looking at how stormwater is being managed on site in reality. So, you know, I think where the risk of greenwashing comes in is where either leaders or segments and sectors of the market are positioning modeled estimate results as a representation of actual performance within the property sector. Thank you.
Heidi, please, over to you.
Sure. So from a sustainable finance perspective, I think there's two things we look at, right? If we do something called the use of proceeds instrument, where we're trying to allocate funding to a specific, you know, green or environmental good, and in the built environment is kind of towards green buildings. So the question we ask is it a green building, yes or no? And from that perspective, we rely on green building certification to a large degree, because that's available kind of external verification It's also around practicality to add another 3 levels of verification just doesn't make sense for us or our client base. That is not in the world of the reasonable. But then additional to that is something that we call an impact and allocation report. So on an annual basis, we ask clients, typically in the industry, to provide us a report that says, we gave you X amount of money, we use that money to fund this particular property, and this is how this property actually performed. And I guess that's a way that we try and gain comfort that the property is also running against the benchmarks that it was created. But I think at the moment, kind of in the industry, the kind of as designed or EBP rating, et cetera, the kind of nuance between those, I'm not sure is always being considered by the financiers, but it's something that I think is part of the evolution of the market in general. But I think so those are some of the protections. And then, I mean, the third piece is kind of around on the actual performance. Some of that is then also being driven quite successfully by what we call sustainability linked loans, where it's really creating targets and saying, if you hit this target, you get a little bit of an incentive, or if you don't hit this target. And that ultimately then is not on a specific building, but it's on a portfolio level, trying to drive a specific property owner's entire portfolio into a specific realm. So there's different mechanisms that we are trying to apply, but ultimately I think it's a partnership and it's a journey to kind of efficiency and working towards kind of best in class.
Okay, great. Thank you, Heidi. Thanks, Georgina. And I think the point is very well made that the market needs to probably get a little bit better at differentiating between modeled estimates, which for the people on the chat, that is when you don't have operational data on the building because the building has just been constructed. And so you are estimating what the building will consume from an energy water perspective versus in-use data where there are actually humans interacting with and occupying the building, and you can actually get a read of what the actual building's footprint is. We're going to close off with Alistair's question, and I'm going to fire it to you, Georgina, because I know you do a lot of work with the public sector. How green are government buildings? Is there an effort from the state to retrofit their buildings to make them greener?
Alistair, yes. So I can't give you a quantitative number in terms of percentage of property. Government is the biggest landlord in South Africa and has definitely supported from an intent perspective that their buildings are all green, particularly through the Department of Public Works and our infrastructure, so DPWI. And they, came out, I think it was 2018 or 2019 at the GBCSA convention, launched their green building policy. So there is a lot of good intent. There definitely are quite a few government buildings, say between about 20 and 30 in terms of the last time that I checked, that have been certified. And those would, typically be office headquarters associated with government departments. But we work very closely with government, to understand what their greening goals and their greening and aims are, so that we can support the training of their teams and different delivery teams associated with, office buildings and the rollout of that. So there definitely are some exciting projects. I think in terms of a coordinated strategy, there is still room for collaboration and support.
Excellent. Thank you very much, Georgina. Guys, I'm going to close the Q&A section of the webinar, and I'm going to move to closing statements. For anyone who sent a question through beforehand or still has questions, please feel free to reach out to us. We will respond to you via email. But I'd like to just start off with Engelbert in terms of closing remarks, followed by Heidi, and then Georgina, your views, followed by Eileen, and then I will give the last word to myself. So please, Engelbert, take it away.
Thank you very much, Anelisa. Yes, and I think it was a very interesting discussion, very insightful. Just being representing a property owner, I think the real estate industry in South Africa was under pressure the last couple of years, and there was a lot of capital constraints, and you need to make trade-offs all the time between, am I going to do this from a sustainability point of view, or am I rather going to repay debt, or whatever the case may be. And it was a fine balance. We had to tap dance around a lot of issues. I think we're coming out of the woods slowly. So I think there will be a force going forward, on the green space. But I also want to say, if you look at IFRS S2, for example, that's in the making. We're going to have to start complying with that, and that talks to some of that risk that we need to quantify. But we've also now got a carbon neutral strategy on the other hand. And then I think every good board at this point in time should have sustainability as a REM component, because if it's going to affect your pay, you're going to tap dance in a different way, and you're going to find ways and means of being a good corporate citizen.
Excellent. Thank you very much, Engelbert. By the way, info for the team, IFRS S2. This is for climate-related disclosures. Google it. Heidi, please, over to you.
Thank you, Anelisa, and thank you for setting up the session. I think that Eileen's presentation is really powerful around making that investment case from the outset. I think we as financiers really like this to support the building of green built environment, especially if there's new property development. But I think a lot of those decisions are often made in various committees, before they necessarily hit our desks. So to have that being incorporated, I think is very useful early on. We can support as much as we can from our perspective, but a lot of this is kind of discussions that are being held by property developers and property owners. So I think so the first part is, I think this is really important from an outcomes perspective to see that it yields better returns, it makes sense from an investment case, and that is something really important to take into various propcoms or whatever the committee is called that you're working under as the first instance. I think the second piece is just the recognition that this is a journey that we're all working towards. So kind of, 4 stars better than no star, and 6 stars better than 4 stars. So kind of that as we go on the journey, to kind of keep pushing ourselves to do better, to do more, to keep growing. And I will completely agree with Engelbert. We've definitely seen the same, is that if the money talks, then people seems to change. So having REM links to it, or linking specific targets into kind of financial agreements, does seem to be able to drive behavior. And then that kind of permeates through organizations, which is a very positive change from things that we've seen. So we continue looking forward to work with the industry, but I think we're open to continuous evolution as we go. Thanks.
Georgina, please.
Thank you, Anelisa. And just a quick thanks from the GBCSA side to you for your fantastic facilitation, for all of the panelists on the call. Growthpoint, thank you so much for the sponsorship of what we believe is really important research for our market, and useful research. And then, as always, Eileen, sometimes these concepts can be quite complex, and you always manage to communicate them very easily and in a very user-friendly way. So thanks again for that. I think in terms of a closing comment, we are standing at a very critical point in our journey, at a precipice, particularly for the property sector. We know that we are responsible for 40% of the emissions. But at the same time, and I think we're all very familiar with this fact, we know that we have off-the-shelf, whether it's design strategies or technologies, and typically quite cost-effective solutions to deal with those problems. So we really are poised to lead this conversation from a sectoral perspective, both locally and globally. And I think the fact that this data and the evidence today has proven that there's also a business case to embark on this journey and to support a lot of the decision makers is amazing. So from our side, really an invitation just to put it out there that we do believe for all buildings that green building certification, if applicable to the context, can really support you along that journey and take you from those ideas and translate that into an impact that is meaningful for you. So thank you.
Brilliant, Georgina. Thank you. Eileen, over to you.
I think everything's been said already, other than I am really excited about the space that we're in, this sort of convergence of climate and this financial investor space is actually being taken up seriously. And Engelbert, your comment about bringing this into REMCO and it being a discussion around the boardroom 5 years ago, when I was talking to excos around this, it was sort of thought of as not particularly important. And so it's climbed the ladder very quickly. it's been a exponential kind of ramping up. So I think the next 5 years are going to be very, very exciting in this space.
100%, Eileen, and I agree with you. I think so many local and international milestones are going to be hit in 2030, and it'll be interesting to see how many assets are really able to adapt to that. Just a couple of closing remarks on my side, guys. These results need to be engaged with by decision makers, not just by the environmentalists or the sustainability specialists like myself, or the tree huggers, as they're sometimes called. Because I do believe that as the market expectations regarding environmentally friendly buildings solidify, the buildings that fail to adapt will start facing a brown discount. And lastly, I think it's worth noting that a property owner doesn't need to be an ESG fund, quote unquote, to see the benefits of certification for the portfolio or for the business as a whole. I think the panelists and the MSCI research have proven conclusively that there's a standalone business case to getting your assets certified. So let's get on the journey. Thank you so much, Eileen, Georgina, Heidi, and Engelbert, as well as all of our guests for joining us this morning. We hope that you found this session informative. Quick reminder, the 18th Green Building Convention is taking place from the 11th to the 13th of November 2025 at the Century City Conference Center in Cape Town. Please feel free to reach out to the GBCSA team regarding attendance, exhibition, or sponsorship opportunities. We look forward to seeing you in Cape Town. Thank you, and until next time, goodbye.
Bye. Thanks, everyone.